Asset-based factoring versus a bank loan. Many small to medium-sized businesses look to asset-based factoring, often known as asset-based lending, in order to provide a quick cash flow. This article addresses the question of whether asset-based factoring is a loan or not. If you are a business owner or financial executive, then this article will hopefully answer some of your questions about asset-based factoring. So the question is asset-based factoring a loan? Or how does asset-based factoring differ from a traditional bank loan, and what are the advantages of factoring over a loan? The answer is no, it is not a loan. Factoring is the purchase of a business's accounts receivable and uses those receivables as collateral when a business has good standing credit-approved customers who normally take 30 to 60 days to pay their invoices. Asset-based factoring is an interim measure used by businesses to create cash flow in the short term. Usually, a business can receive upwards of 80% of the entire amount of the gross invoice. Eventually, once the client pays the invoice directly to the factoring company, the business will then receive the remaining 20%, less a small percentage, which is the fee paid to the factoring company for purchasing the receivable. For example, if a business has receivables of $100,000 after approval, the factoring company will immediately disperse $80,000 to the business for it to use to cover for its daily operations and expenses. 30, 60, or even 90 days later, once the client's customers pay the invoice directly to the factoring company, the factoring company then sends the remaining $8,000, known as the reserve, to the business, less the factoring fee of, say, $2,000. For the factor's security, and in order for it to be able to advance literally millions of dollars to the client, the factor takes a GSA, which is a General Security Agreement, over the client's assets. Here is the difference between lending the client money and buying its receivables. In factoring, each time the factor buys a specific receivable or invoice instead of making a loan. All invoices are confirmed telephonically and the paper trail checked both for the client's and for the factor's protection. No interest is paid, but there is a fee earned. One of the differences between a loan from the bank and selling receivables is that the factoring company is not concerned so much with the client's business as it is with the creditworthiness of the business's clients. If accounts receivables from a particular client are and have been in good standing, then usually that is enough to receive immediate monies from asset-based factoring. Another advantage of asset-based factoring or lending over a bank loan is that factoring companies usually approve the application and disperse cash quickly. Also, there is no deadline in the business's balance sheet. One more major advantage is that a factor can advance a lot more money than a bank. The reason for this is simply that a factor relies heavily and almost totally on the client's customers. Visit www.ifactoring.ca for more information on asset-based factoring.